What's up, guys? Aesthetic Crypto back again to give you another update about cryptocurrency, NFTs, blockchain, finances, everything you need to know about Web3 in that space. This specific video is about the current correction that the cryptocurrency market is going through and a couple of things that I think will act differently from the market. But before all of that, I want to say thank you so much for dropping by. I really appreciate it. If you could take 2 seconds to like the video, I think it's really important that we get this information out, and that is how I get this video to a wider audience. So thank you so much for liking the video. If you're here, subscribe already, and I appreciate it. Let's jump right in. The cryptocurrency market is taking a breather, as you would say. Honestly, since the highs in November of 2021, where it was at 69,000, we're seeing a 50% correction at the current moment, where Bitcoin is teetering around 35,000. We saw similar things happen in the summer of 2021, where in May it was about 65,000 and it dropped to 30, 33, sometimes 29,000. As we see, there's a few things that could be going on here, and I guess everybody's wondering why. Now, I'm not a financial advisor, I can't see into the future, and these reasons might not be it, but the larger sentiment is saying these few things. First of all, first and foremost, the cryptocurrency market is still very, very young. Bitcoin was created in 2009. That was 13 years ago. That is the oldest cryptocurrency, and this market is barely a decade old. So that is kind of the risk reward you take with investing in an asset class that's still so young. The volatility is always going to be there. So I think people need to take a step back and realize that this is normal in the cryptocurrency space, and not to trade and invest off of emotions. The second thing I would say that's causing this negativity and the price to fluctuate is the Fed Chairman Jerome Powell. Now, last year in 2021, he stated that he was going to be more hawkish. And what does that actually mean? Before I get into it, it just means more stringent, more strict, and they're going to actually pull back on how much they're paying and getting government bonds, which is holding up the market right now. They're also going to raise interest rates in March, and they basically doubled down on that. So basically being more strict with the money, trying to fight inflation. Now, I think we can all agree that trying to fight inflation is good, but if you're invested in an asset class, that does not mean good for you, because when it costs more to borrow money, when interest rates go up, people will borrow less, invest less, save more. It's just general economics. That's why I guess they're trying to time the market, because people understand what's going on, that fear creates more fear even when something hasn't happened. What kind of aligns with the third reason, if you're into TA, which is technical analysis, you'll see in the charts that what they call a death cross has happened, and that is a lagging indicator showing that price is moving downwards. But even when that happens and people see the death cross, they react and do things after the fact, which creates even more of a dip. The same thing happens if there is a golden cross. Now, if you don't understand what death cross and golden cross means, it's just multiple lines showing you the average price of what Bitcoin should be. And if those if you have 2 lines and they cross each other, different averages, that creates a death cross or a golden cross. And that is really a lagging indicator of price action, whether it's gone up or down. More on that later. It's more technical. You don't really have to worry about that. It just shows you what has happened in the recent weeks and days when it comes to the cryptocurrency price and value. Those 3 reasons, one, like I said earlier, with it being a young and small volatile asset class. 2, the Fed Chair Jerome Powell saying he's going to raise interest rates in order to help inflation. And 3, for the simple fact of the matter, whether we like it or not, we are emotional creatures and we react. If we see things, we might do things because of them. If somebody is a technical analysis and they see a death cross, they know that people are going to react to that, so they might take out or invest or do things differently. Those three reasons are probably the biggest and most theorized things that's making the market move. But to be honest, nobody knows. This is so young, this is so new. We can't have that one reason that's just factual, because nobody's a magic genie or a guru. We just have to work off what we theorize will happen in the long run. I think I don't know who said it first, but all the investors know when there's blood in the streets, you should buy, even if the blood is your own. And what that simply means is act differently from the market. If you see that price is dropping and you're going to sell at a loss, why not try to dollar cost average into that? If and only if your theory of you investing in that is important and for the long run. That is how you should invest. Take the money, put in the money when it's low, take out when it gets high. But everybody knows that, but doesn't have a theory about that. So I think aside from the fact of the cryptocurrency market, I think NFTs can be a hedge against at least Ethereum. As you've seen, if you've been active on OpenSea and actually used and worked in NFTs, you see that they ebb and flow almost. When Ethereum is up really high, NFTs are not doing so high. When Ethereum is low, the bull market in NFTs starts to come. So they kind of ebb and flow. It's not exact all the time, but if you want to hedge against what you have in the crypto space, you can use what you're doing in the NFT space. Now, I would say that this only works for blue chip NFTs. You can't jump and ape into every new project and put in ETH and think you're going to store it and that people are going to buy that when that project was shit in the first place. So the hedge against Ethereum and other cryptocurrencies would actually be NFTs that actually have the value in them. The CryptoPunks, the Bored Ape Yachts. The list actually does go on, and I think it's getting bigger. There's so many new drops that I think are going to get big and stay big in 2022. NFTs have a long way to go, in my opinion, but that's neither here nor there. I think Journey said it best. My sentiments exactly. They're a hedge against Ethereum, but I would say with the caveat, only blue chips are a hedge against Ethereum. I think even LEO trades is in my same kind of a thought process. The decoupling, the detachment, how acting differently from the market certain subgroups can be, like metaverse, NFTs, gaming coins, things that are going to explode regardless of what happens to government policy, the Fed hiking one way or another. This chart is beautiful. It shows just how crazy big video games have gotten, different spaces have gotten, and there's only more room to grow. I think, if I'm not mistaken, because I haven't been keeping up to it, Leo and Alex are doing a Twitch live right now for $1 million prizes, and that's just the start of it. Because I know if you've been in the NFT space long enough, you know Neo Tokyo Trades shot up through, and it was a crazy good experiment that they did, and it's so far succeeding. And now they're really into the gaming space by getting people to watch Twitch live. People play against that. Ridiculous. So I would say subgroups of coins like metaverse, gaming, stuff like that, NFTs, other things that aren't necessarily fully aligned with crypto would be a hedge against crypto and might actually detach and do their own thing and not rely on the price of Bitcoin as everything is doing right now. That's just my opinion, not financial advice. If you made it this far, appreciate it if you give a thumbs up. Thank you very much. I don't know why I'm peacing.